The time of waiting is at the end. After enormous layoffs have already pushed down the employment rate, the Federal Reserve has just trimmed the rate hike to 25 basis points, suggesting that further bigger rate increases may soon be coming to an end. The financial markets are preparing for the biggest decline since 2008. Weak retail sales have led to a decline in consumer sentiment and subsequent slowdown in the housing market. Since the Fed has decided to go for more gradual rate hikes, some Fed members feel the pause could come much sooner than planned. This is why it is important to have an open dialogue about what is going on. And so, this is Investing Path, and for today's video, we will be talking about the Federal Reserve's warning over the next several months and explain what you might do if things don't go as planned, because this might create a new trajectory we haven't seen in over a year. But before that, make sure to hit the like, subscribe, and bell button to stay updated with our future uploads as we go on. Now, let us not spare minutes and jump right into it. We got a breakdown before discussing the Fed's latest rate hike and their caution for the remainder of 2023. There is more going on in the market right now. The Federal Reserve has been on a rate hiking campaign for the past year in an effort to control inflation. The issue is that they don't have a great history of precision. Most people don't know that the original projections for the target federal funds rate by the end of 2022 were somewhere around 1.9%. However, in April, it was lowered to its current value of 2.75%. In addition, we've set our sights on 5% in the next few months, and at this rate, we should be there very soon. A positive note is that it seems to be effective. Inflation has been trending downward over the past half a year, from a high of 9% in June 2022 to its current level of 6.50%, which is still rather high but on the decline. Although layoffs are bad news for the middle class, they're music to Jerome Powell's ears because they indicate that the wage growth is finally slowing. The prevailing view holds that rising prices are a natural result of a healthy economy, as rising wages lead to more consumption. This provides the Fed with additional evidence that the economy is not slowing down as previously thought. In terms of the effects on stock and real estate prices, the most recent data is particularly informative. With regard to the market's future course, if we look at the property market, we see that in cities like San Francisco, sales of luxury homes costing around $5 million have dropped by around 70% in the past year. The average time a home spends in the market has increased across the board. The average monthly cost of a home has risen by 62%, making it the primary impediment to home buying right now. What is happening with the stock market is another effect of interest rates. As we indicated earlier, the stock market has risen from the 99 level all week long on expectations that the Federal Reserve will raise interest rates by 25 basis points. Then, either pause or continue hiking rates at a considerably slower pace than in the past. The reopening of China's economy has sparked optimism that the country would be able to reduce supply chain bottlenecks, increase demand, and boost international trade, all of which will eventually result in happy investors taking selfies with their Wall Street winnings. Others argue that China's rising need for oil-based resources and consumer products could contribute to higher inflation. Despite the fact that China could be the engine behind surplus growth, this means the Federal Reserve may need to keep raising interest rates for a longer period of time than previously thought. Chinese demand for energy and raw materials will compete with that of Europe and the rest of the world. Accordingly, we expect inflation to ease for the time being, with pressure on it will build in Q3. And the bad news is that Michael Burry already warned us about this, that there have been periodic surges of inflation in the past. After the problems with the fool's people is fixed, a graph demonstrating that inflation has been a constant since the 1940s is presented. When inflation falls, consumers may spend freely for a few years before it surges again. It is also important to remember that the White House conducted its own study of inflation following World War II and found that, on average, it took several years for inflation to return to pre-boom levels, and that it never returned to pre-boom levels within a matter of months. So, while we may be seeing some good news with the Fed in the rate hikes, it is not yet finished. On the bright side, however, The average expert predicts that the SP 500 to close the year above 4,000, with the range anywhere from 3,500 to 4,500, and a record amount of cash is resting on the sidelines. They go down, though we will stress that a lot of it hinges on the Federal Reserve's decision over the past several months, and that you will want to pay close attention to what they have to say about their most recent decision right now. Although it may come as a surprise to some, the falling inflation rate over the past few months has led to the market pricing in a rate hike of 25 basis points. Traders are presently pricing in one more 25 basis point rate hike at their March 22nd meeting, and then a pause until they see what happens. But the actual question that everyone wants to know is simply when will the rate hike stop? According to the chief economist of ING, declining inflation in the United States indicates that pricing pressures are reducing in the context of a robust labor market. It is believed that the Federal Reserve will not give us any clue on what is going to happen too far in advance, as there is concern that if investors think inflation is finished, they would spend more money, leading inflation to endure even longer. A peak federal funds rate of 4.75 to 5% is now being priced in, but this will change based on the facts and data we receive between now and March 22nd. But on the bright side, inflation expectations among consumers have dropped to their lowest level since April 2021, at 30.9% for the coming year, suggesting that the Fed's approach may be bearing fruit. Let us take a quick look at why the jobless rate keeps going. The number of jobs lost in recent months is shocking, yet many of the same organizations have employed so many people in the recent years that even with the layoffs, they still have more employees than they did before the pandemic. That is why it seems to us like businesses had no choice but to ramp up hiring during prosperous times while cutting back during leaner ones. This could mean further layoffs are possible if necessary, or it could mean they are waiting to see what happens with inflation month to month. Regardless, it appears that employment levels have returned to pre-pandemic levels, and wage growth has returned to more or less normal levels. On a different note, we're worried that there isn't much reason for hope following the most recent rate hike. Good earnings are expected, and China has reopened, but investors remain wary that the Federal Reserve Board will need to raise interest rates further to keep up with the rising demand, which will keep the pressure on the market. In addition, many people are turning to money market accounts as a place to store their savings because they pay over 4% and are low risk. Only time will tell how it pans out when compared to the stock market or real estate, or if the stock market needs to drop much more to tempt those people to invest back in. We do think it is a step in the right way, and with both England and Canada anticipated to slow their rate hike cycles in the coming months, we may be nearing to conclusion of the rate hike cycle. But so far, let us know your thoughts about this one, and we'd be more than glad to join in the conversation. But besides that, thanks for watching. This is Investing Path, and if you enjoyed watching our content, then go ahead and hit the like, subscribe, and notification button to stay updated for more of our personal financing and investment uploads for you. Thanks again for watching, and we'll see you in our next video.